Good morning. I am Fabrice Tayot, Head of Commodity Proposition Emerging Market at Refinitiv, and this morning I have the pleasure to sit with Glenn Wepener from First Abu Dhabi Bank to talk about the current state of the oil market. Good morning, Glenn.
Good morning, Fabrice. It's
How
a pleasure.
are you?
I'm very well, thank you. It's a pleasure to be with you here today.
It is indeed a pleasure. So, Glenn, you are the Executive Director of Market Insight and Strategy for First Abu Dhabi Bank.
That's correct.
And you've been covering the energy market for many, many years.
For quite a while, that's right.
Yeah. So I am very interested to know what you think about the current state of the crude oil market. What do you think investors should be keeping an eye on?
Sure. Well, I think, look, we just take a little bit of a step back. Obviously, we've had a significant rebound in oil prices since the lows of early 2016 when WTI dropped to below $30 a barrel. The primary drivers of that we know, obviously, the global economic rebound. Number two, which for me is one of the more important ones, was the success of the OPEC-NOPEC output cut agreement, which analysts at the time, I think, were a little bit skeptical whether or not it was going to exceed, particularly with regards to adherence levels. But in fact, adherence levels were very high. Some of them were over 100% for some of the larger producers. And what that resulted in was it helped to reduce the overhang of inventories that had built up since early 2014. It also, in my mind, nullified to some extent the impact of the resurgence of US shale production that we've seen quite recently. Now, looking forward to this, the third driver, geopolitics. And that's been the prime one for this year. Obviously, the US withdrawal from the JCPOA agreement in May has been a big driver for prices. More recently, however, as you know, we've seen a drop-off, a retracement. I think that's been quite healthy, to be honest, for the market. I think it's a good technical retracement from the highs that we saw of $85 barrel for Brent down to the current low 60s. I think that's shaken out some of the long speculative positions from the market, and I think we're starting to form a base here. For our outlook over the next 3 to 6 months, we're looking at a range of around $60 to $85 a barrel for Brent until we can really ascertain the impact of the sanctions on Iran. So that's our outlook. Things to look out for. Obviously, on the downside, we still have the US-China trade dispute bubbling away, and it doesn't seem like it's going to be resolved anytime soon, hopefully next year. That, obviously, if it worsened, could put pressure on the global economy and consequently oil prices. On the other side, on the geopolitical aspect, I think Venezuela is still an ongoing issue. The social and economic meltdown, sadly, looks to continue and obviously affecting their production. And then there's Nigeria. Nigeria has in the past had issues with militant activity, separatist activity in the Niger Delta region. Not so much this year, but next year we're facing elections. So that could be an issue to watch out for. And then finally, I would say Libya. Libya's production's actually recovered quite well this year. But in the early part of the year, you'll probably remember where there was significant disruption at certain facilities within the oil crescent. Because of the general state of political insecurity in the country. And until that is sorted, that risk remains.
You mentioned Iran a few
Yep.
minutes ago, and if you don't mind, I would like just to focus a little bit on that.
Sure.
Since the 5th of November, a new series of economic sanctions have been imposed on Iran, limiting their capacity to export crude oil.
Yes.
According to Refinitiv Oil Research, we estimate that Iran is exporting on average on a monthly basis in 2018 61 million barrels. So what do you think will happen if this export has to cease? What do you think will be the impact on the global supply?
Well, I mean, your data is absolutely correct. I mean, we've seen a resurgence in oil production out of Iran. In end of 2015, I think they were producing around 1.1 million barrels per day. Since the sanctions were lifted in 2016, that has risen. It peaked this year in July. I think it was 3.8 million barrels per day, and exporting over 2 million barrels per day, as your data reflects. I think it's a little early still for us to be given, to ascertain exactly what the impact is going to be and how much you will be affected. The reason for this really is because of the U.S. decision to grant a sanctions waiver to 8 of the countries that Iran exports to. These are the major export markets for Iran, to give them time to find new sources. So I think it's probably going to be mid to late next year when we'll actually be able to get better figures for that. What I would say, however, is that the effect on the Iranian economy has already started to take place. In fact, it started before the official withdrawal of the U.S. It started when Trump started suggesting that he was planning to withdraw. What we've seen is a sharp devaluation of the Iranian rial this year. We've seen inflation skyrocket. In fact, the last count I saw was above 36%. Unemployment has risen. And consequently, what's happened is you're starting to see protests across the country about the cost of living, about jobs, etc. And I think that will continue next year. But again, it'll take some time before we actually get an exact figure on how much Iranian production will be affected.
That's really interesting because a lot of people are currently talking about U.S. crude production potentially mitigating the supply risk.
Yep.
If I remember correctly, the U.S. Energy Information Administration just assessed the American production around 11.3 million barrels per day, which is approximately 20% higher than 12 months ago.
That's right.
Once again, I think 12 months ago it was 9.2 million barrels per day. Quoting another source, Baker Hughes says then last week there was 888 rigs drilled, and there was more than 8,000 well drilled but not completed in the US. Both figures are the highest level ever, at least until 2014.
Yes.
So these are big numbers. Those could be potentially game changer. And I just would like to know a little bit more your point on the end. Like, do you think this is here for the long term, or do you expect to see some challenges with this continuous growth of US supply?
You used the right word there, game changer. It has been a game changer, particularly for the US energy sector. The US is now, as you mentioned, a net exporter of oil as opposed to an importer. However, what I would say is that I don't personally believe that this is a long-term source of reliable supply for the oil market. And the reasons behind that is more geological than anything else. In the short term, what we've seen, as you said, we've seen a sharp rate of growth from these shale companies, particularly as the oil price has risen and technology has improved. I think for the next few years, this will continue, although perhaps not at the speed that it has done. We've seen initially this year, we've seen some issues with infrastructure. Obviously, there's been some capacity issues in terms of pipeline getting the commodity to market. Obviously, it's not just oil that they need to put through these pipelines. It's also the need to get rid of the dirty water that's created from the shale drilling. But they are getting around that. Another issue they've faced has been the fact that a lot of the U.S. refineries historically were built to process heavier crude rather than the light shale crude. But they'll slowly get around that as well. My issue with shale is, as I said, is more geological. If you just look at a shale field, it's very quick to get up and running, 3 to 6 months, as opposed to conventional, which is 5 to 10 years. The decline rate, however, as in the lifespan of the fields, is quite short. It's 70% in some cases over a 2 to 3 year period. So they have to keep opening up new fields in order to do that. And by doing that, they're damaging the geology and the ability to get more oil out of the ground. We've seen a little bit of that in the Eagle Ford Basin. We've seen the quantity and quality of oil there decline. The Permian obviously is the big one at the moment, and that is pumping at full tilt and probably will do for the next couple of years. But logically, in my mind, what happened that we saw in Eagle Ford will eventually start happening in the Permian, and then you start getting less and less sweet spots across that whole sector. At the same time, too, I think, if you look at the financials of some of these shale companies, their performance this year has been less than dazzling, to be honest. There's still a heavy debt load that they need to shake off. So we'll have to see. My concern really is, because as I say, I don't see it as a long-term reliable source of supply. My concern at the moment is the large drop in capital expenditure in finding new conventional sources of oil, and that is something that could lead to a supply crunch further down the line, particularly if you consider the fact that spare capacity currently, and this is according to IEA numbers, is around 2% of global demand, which is quite a thin buffer.
Glenn, you just mentioned the lack of capital expenditure.
Yep.
Can you elaborate a little bit more about that? Because I think it's a very important point.
Yeah, sure. And you're right. I mean, it has been highlighted by some, including ourselves before, but it's probably not hit the mainstream as yet. Let's look at a couple of facts and figures. Natural demand for oil is growing at the moment at around 1.3 million, 1.4 million barrels per day. However, as I said, capital expenditure has dropped dramatically in looking for conventional sources of oil since 2014. Understandably, obviously, low oil prices, the big oil companies had to reduce costs. However, the situation that it's led to has, for example, in 2016, we discovered around 2.4 billion barrels of oil. Now, if you look at the 10 years prior to that, the average per annum being discovered was around 9 billion barrels. At the same time, green-lighted projects, so these are projects that are conventional projects that have been given the go-ahead to proceed and move towards production, are at their lowest level in 70 years, which is pretty much unprecedented. There was a study just recently done by the IEA, and they suggest that we need to discover around 18 billion barrels of conventional sources of supply every year for the next 5 to 7 years in order to keep up with demand. There was a separate study, you may have seen it, by Rystad Energy, the big Norwegian energy research house. And basically, they are estimating that if things continue as they are, we're going to run into a supply gap by 2030 of around 3 million barrels per day, and by 2035, 9 million barrels per day. Now, as I said earlier, if you consider the fact that we have pretty much a wafer-thin spare capacity around the world at the moment of 2%, it's going to be a struggle. What's going to come in to replace that?
So, in conclusion, you don't really believe in shale as a long-term reliable source of supply.
Correct.
You are aligning the lack of capital expenditure, but what about renewable?
Renewables, I will agree. I think that is the long-term game changer, particularly areas such as solar. The only thing that I have with it is I think that it's further out than we currently anticipate to be. Let's look at electric cars, for example. Electric vehicles make up around 2% of total vehicle sales around the globe. They're relatively still expensive. In the countries where they've sold well, such as Hong Kong, such as Scandinavia, it's really been driven by the fact that the government's been offering tax rebates and discounts and so on for people who buy these vehicles, and these rebates are slowly being withdrawn. The infrastructure to support the vehicles is not widespread at the moment. That's going to take time, and it's going to cost a lot of money. And at the same time, look at electric batteries. The inputs for electric batteries, lithium and cobalt. Now, if we take cobalt, it's not a rare earth mineral, but many people will be surprised to know that more than 60% of our current source of cobalt comes from one country, and that's the Democratic Republic of the Congo, which sadly is not the most stable of places historically. Look, technology will get around all of these things, and batteries will improve, infrastructure will be built, and we will get there in the end, but I just think it's going to take longer than we currently estimate. Fossil fuels, we're still using, it still provide around 80% of global energy demand. And Shell did a study a couple of years ago, and they estimate that will fall only by 3%, so 77% still reliance by 2040. So, fossil fuels, crude oil in particular, I think is going to be around for some time to come. But yes, I agree that in the long term, renewables is the answer.
Thank you, Glenn.
Thank you. It's been a pleasure.